OYO is bringing the IPO bell once again, and this time they are bringing a headline that's hard to ignore. A claimed 748 crore in profit over just 9 months. To understand why the specific number is so loud right now, we have to look at the financial roller coaster this company has been riding. This chart plots OYO's targeted valuation. In 2021, they aimed for a massive 12 billion valuation. By 2023, it crashed to just 3 billion. But now, aiming for a 2026 listing, they are shooting back up, asking investors for 7 to 8 billion. Tripling your company's worth in 3 years requires a highly compelling pitch. You need numbers that prove we have completely turned the ship around. That is exactly the role the 748 crore profit figure is meant to play. It's the ultimate selling point aimed straight at retail investors. As profit that high makes an 8 billion price tag sound reasonable. But in the world of initial public offerings, a profit on paper and actual cash in the bank are two very different things. Let's look inside that 748 crore figure. You might assume OYO made this money by booking a record number of hotel rooms or by drastically slashing their operating costs. But a closer look at their financial filings show that the day-to-day hotel business is not what's generated this vast majority of this money. Let's look at this breakdown of total 748 crore. A massive chunk, 559 crore, comes from a single item called a deferred tax credit. That means nearly 75% of the total profit is coming from this tax entry, not core operations. OYO's financial turnaround relies heavily on an accounting categorization rather than a sudden explosion in people actually booking rooms. To be clear, a deferred tax credit is perfectly legal. It is a standard accounting practice. Here is how it works. When a company loses money for several years in a row, the tax code lets them keep running tally of those heavy losses. This flowchart illustrates why that tally matters. The government allows business to use those red past losses to offset taxes, turning them into green future tax savings. The rule also allows pulling those expected savings onto today's balance sheet, recording them as profit right now. Because this is entirely based on future tax rates, not a single rupee of actual physical cash entered OYO's bank account to create this number. It is an accounting maneuver that takes a history of losing money and repackages it as a massive on-paper profit exactly when the company needs to impress the public markets. So what happens when we strip away the accounting maneuvers? Of the 748 crore net profit reported for the first 9 months of financial year 2026, only 559 crore came from a deferred tax credit. And after accounting for a separate 129 crore one-time gain from a subsidiary stake sale, OYO's profit before tax was around 245 crore. To be fair, generating that amount in operational profit is a genuine milestone for a business that faces intense competition. But the real profit is only a quarter of the number they're plastering across headlines to convince investors they're worth 8 billion. Companies going public know that a lot of everyday investors will simply read the top line number on a news sticker and buy in without ever digging into the fine print. When a struggling company re-emerges with a sudden profit right before asking for your money, don't just trust the headline. Strip away the accounting and follow the actual cash. If you like this video, please like, share, and don't forget to subscribe.